Hey there, this is Jacob Wood with Douglas Elliman Real Estate, and I have for you here the Q2 2022 Spring Manhattan and Brooklyn Market Reports from Douglas Elliman and Miller Samuel. Now, in a media environment of rising interest rates, economic uncertainty, and talk of a recession, the Manhattan Quarterly Report shows record median closing prices in Q2. Now, what's going on there? Well, we need to remember it takes between 3 and 4 months to sell a co-op or a condo in this city, and so purchase prices are trailing data. These homes that set record closing prices in Q2 were listed in Q1 and are indicative of that fast market we had earlier in the year. Frenetic pace, lots of demand, higher buyer confidence, historically low interest rates, and very low supply. So what are the facts on the ground now? The market has slowed down, as we see in the monthly contract signed reports that are more indicative of the energy on the ground, that over the past couple of months we've had fewer contracts signed than year ago, 2021. And so buyers have pulled back some due to rising interest rates. Now, New York City is more resistant to rising rates than the rest of the country for reasons that I'm happy to get in more with you, a variety of reasons I can get into more with you. If you're interested, give me a call. Additionally, none of the buyers that I'm working with have pulled out altogether or even categorically changed their parameters due to rising rates. I mean, if you're only a buyer at 3.5 on a 30-year fixed, but not at 5.5, then you were probably never a buyer to begin with. Additionally, there were a lot of buyers that felt priced out of that fast early 2022 market. And as soon as they sense any pace correction, any price correction at all, they're going to perceive it as their opportunity and they're going to jump in. Now, another factor that is acting as a counter to rising rates and providing energy to our market is the frenetic, dysfunctional rental market. I'm working with buyers who are purchasing because they're priced out of the rental market. It costs less money per month to own in Manhattan right now than it does to rent. That's never been true as long as I've done business here. It's usually only true in categorically lower priced markets. Places like San Francisco, New York, you just resign yourself to paying a premium to buy, and that's not true right now for the first time in as far back as I can remember. Now, some other factors that I like to look at to try to gauge what a market is likely to do are value appreciation over the past year, 2, 3 years. Take the nationwide real estate market as an example. It's appreciated in value 40% over the last 2 years. I mean, those are Bitcoin numbers. That is a market poised for a correction. In New York City, our record median closing price in Q2 is 11% higher than that same metric in fall of 2019, just before the pandemic did what it did to our market. And so long-term average value appreciation in New York City is 4.5%. So over the past few years, we are slightly below that long-term pace. Our pricing isn't out over its skis at all. Another thing we can look to is the luxury new development market. Let's say you're buying a 6-figure co-op. Odds are you're buying because you have a strong push. You just started a job, started a family, your lease is running out. If you're buying an $8 million condo, you're buying because you feel like it. That's an elective purchase. Those buyers tend to be attempting at least to time the market. We saw twice as many new development closings in Q2 22 than we did in 21. Now, going back to the resale market, record pace, frenetic pace, 12% more closings in Q2 than a year ago. 100% more new development closings this spring than last. All new dev price metrics are up versus a year ago. Buyers who can time the market, or at least give it a shot, are perceiving a lot of value in new dev right now, and they're getting in. Another factor we can use to gauge what the new development market is likely to do over the next several years is look at number of permits for construction being filed now. In the past 12 months, I think there were only 7 permits filed for ground-up construction in Manhattan for residential new development. That is a drop in the bucket compared to demand. Now, an interesting facet of the new dev market is we see a dramatic increase in supply this spring as well. So supply and demand shooting up at the same time. What's going on there? It's not actual new supply. New development has been dealing with a glut of shadow inventory since the middle of the last decade. Developers have been waiting for the right time to put on the rest of their supply, and they perceive now as the right time as they see the buyers jumping in and being more active. So let's say you have a townhouse in Brooklyn, a co-op on the Upper West Side that you own or you're looking to own, and you're interested in how that specific submarket is performing. Let's talk more. This is Jacob Wood with Douglas Elliman Real Estate.